What is bank draft?
Bank draft is a type of check.
The bank guarantees payment, making it a more attractive option for the check recipient.
Before creating a bank draft, the bank itself verifies that the customer's account has sufficient funds available. It then creates the bank draft for the account holder.
Bank drafts are often used when there is a large amount of money involved or when there is a high risk that a check could bounce. Party involved in bank draft. A bank draft is required by a seller when the seller has no relationship with the buyer, a transaction involves a large sale price, or the seller believes collecting payment may be difficult.
Bank draft example. A seller requires a bank draft when selling a home or automobile. A seller might not collect funds with a bank draft if the bank becomes insolvent and does not honor outstanding draft, or if the draft is fraudulent. Procedure in bank draft. 1. Step 1. Seller or buyer sign purchase contract.
Step 2. Within 3 days upon signature of purchase contract, the seller issue a bank draft in favor of buyer and email the soft copy of the bank draft to the buyer for confirmation.
Step 3. Within 3 days upon confirmation of bank draft soft copy, the buyer must pay 1% of bank draft face value by wire transfer into seller's bank account.
Within 3 days upon confirmation of the 1% of the bank draft face value, the seller will deliver by the the courier hard copy of the bank draft to the buyer bank within 3 days.
Step 5. Finally, buyer shall, within 3 days of confirmation of the bank draft, hard copy pay 52% of face value to the seller via wire transfer, as well as pay the brokers their 2% commission fees.
Advantages of bank draft. First, lower risk in carrying large amounts of cash to abroad. Second, be efficient and high secure in settlement. Lastly, gain opportunity to use other banking products and services.
Disadvantage of bank draft: slowness of the transaction,